to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hey, good morning, Sip. Hey, everybody out there.
Today is July 21st. This is episode 91. I feel like a common theme this week is earnings, summer doldrums, a little bit of market stall. We're continuing in this move in the positive direction, slightly at that. What are your thoughts? Where should we begin today's episode?
I mean, first we have to say that I think you're the host of the show. I'm not sure if we need to have that girl change the beginning, because it says AJ Brown's the host, but I like you as the host. I just like being the
expert.
Anyway,
okay,
expert,
I'll be the host. You be the expert. You're the guy. Can we make money in this market, AJ? Is there money to be made?
Absolutely. And one other theme of this week is definitely bad news is good news, right? Because if you look at all the economic news, so on Tuesday we had retail sales. Tuesday we also had industrial production numbers. Wednesday we had housing starts and permits. Thursday we had existing home sales. They all came under target, right? And so, you would think that that's bad news, but what that tells investors is all of these tactics that the Fed took last year and into this year, they're finally taking hold, and that gives investors relief that the Fed may take a break. In fact, let's take a look at what investor sentiment is for raising rates. So I'm going to go ahead and bring up that CME group numbers here. Here it comes. I'm going to bring it on over here. This is that graph. And so they're still believing, they're still believing that there's going to be a 1/4 point rate hike. And this is happening next week, right? They're going to be meeting on Tuesday and Wednesday of next week. And then Wednesday, they're going to announce any sort of policy changes. And so you can see here at this point, investors are almost 100%, 99.8% positive that the Fed's going to raise another 1/4 point rate hike. But I believe that investors, and that's what we're seeing in the market today, investors kind of believe, this is the VIX. Well, you could see it in the VIX too. You could see that there was a little bit of a spike about 10 days ago, but now it's at it's at recent lows, telling you that investors are kind of calm about what's going to happen next. They know that there's going to be a 1/4 point rate hike next week, but I think that investors are kind of believing in this whole story behind a soft landing, and believing in this whole story behind maybe we're going to take a pause after next week's 1/4 point rate hike and just let things float for a little while.
And so does this mean that it would be a surprise if they didn't raise, right? That would be the surprise to the market, is if they paused with some sort of verbiage in terms of, hey, we want to just wait and see what happens.
Yeah, it would be a surprise. I mean, at this point, if 100% of those investors that are being polled are thinking that there's going to be a 1/4 point rate hike, even having no rate hike would cause, some unneeded volatility. I almost feel like, is the dog wagging the tail, or is the tail wagging the dog right at this point? When you have this many people believing in this, you almost don't want to deviate from that. And if I was the Fed, even though they're not supposed to take investor sentiment into their decisions, I think maybe we never know what happens behind closed doors.
And then when we look at the S&P, we're continuing to stagger to the upside a little bit there. It looks like we're having a little bit of a pullback this week, yesterday, on some of the tech earnings, but still in that direction.
I hope for, because I saw and I specified that there was overhead resistance at 4,600. So around this range, I would hope that we have a little bit of a contraction. And you can see I've got this line of ascending resistance that I've drawn. And so I would almost believe 100% that we would see a pullback. In fact, I'd like to see a pullback and find out whether this level, this magenta level I've drawn, let me zoom in a little bit so folks can actually see what I'm talking about. First of all, before I zoom in, you can see that we've had this uptrend since, the first couple of weeks of March, but the uptrend was a little bit hairy, as we've been pointing out week in and week out. It was hairy until we started to get until about May. And then it started to really gain some steam. So if I zoom in a little bit since May, maybe to the last 3 months, what you can see here is we started to gain steam. We call these ideal movements. So this was an ideal movement. This one I'm kind of squiggling over in yellow. This was an ideal movement. This was an ideal movement. Almost all the movements we've had, whether it be a pullback, we call that contraction, or an expansion, have been ideal. And my big question right now is we're almost, we've got high number confidence in this being the ascending line of resistance and this being the ascending line of support. And I guess my big question is lately we've also been testing this level as an ascending line of support. So I'd like to see a contraction phase and find out whether we're talking magenta or cyan as our level of support, because that'll help me in making my decisions moving forward on different sorts of trades, different sorts of positions that I might want to take. And I always have to emphasize one last thing. If I go back about 18 months, we do know that there's pretty heavy overhead resistance, like I was saying earlier, at 4,600, and then our all-time highs at 4,800. So I fully expect that we're going to have some challenges getting through those two levels, but I don't think that's impossible. We'll see as the summer doldrums draw to a close at the end of August, and into the fall, retail season, the holiday season. We'll see if we can blast through those numbers. And if so, we're on the verge here at Trading Trainer to call this market full on bullish.
That's interesting. And I'm assuming that some of the earnings calls this week, last week, next week are having a bit of an effect on this, increase or move to the upside. And once that gets flushed out, we'll get back to overall economic themes.
I was paying attention to some of the economists. I mean, they are bewildered, right? Because employment's good, earnings are good, and inflation is coming down. And so this is a scenario that we kind of haven't experienced yet. If you look at history, we also, with documenting what's been happening, we really haven't dealt with a pandemic before. And so, the economists draw on past data to give people guidance on what's going to happen in the future. And they've been wrong, right? A lot of economists jumped on the boat of inflation would be transitory. That was wrong. And then a lot of people have been jumping on the boat that if you can control inflation, then employment and earnings is going to get hammered. And that's been wrong, right? Earnings is good. Inflation's coming down. I mean, it's like we're in uncharted territories, but yeah, earnings have been good. Consumers have been spending money. Earnings is still up. Inflation is coming under control. U.S. inflation is coming under control faster than most of the world inflation. I mean, we'll see what's happening. I know that there's a lot more skirmishes building up with the whole Ukraine-Russia thing. So, best to the folks over there. But hopefully that whole disturbance of the grain market doesn't trickle down into the broader market, which is going on right now. But things are good. And so we'll see as the summer doldrums play on. But I mean, and as traders, as investors, we've got all sorts of different plays that we can be doing right now.
Yeah, and that's what that's what I want to dig into. What I think
we're all
what
about.
I think some of the viewers are tuning into. But before we dig into some live show examples, let's just go ahead and give everyone that's watching the opportunity to throw a ticker out at us. If there's a name that you want AJ to go over, feel free to throw it in the chat. At the same time, if you haven't checked out AJ's amazing daily workshop, the 4 shortcuts for growing your investment account to a 6-figure income, we've just thrown the link to that in the chat. So if you're looking to get a little bit more detailed analysis, little more of a detailed breakdown of the strategies, some more examples, head on over there, sign up. That plays every day. So if you want to make some time later in the week, next week, just save the link, sign up. We're going to go ahead and take a bit of a break here. We'll be back to go over trending topic, AJ's pick of the week, our speed round, and any tickers that you guys bring up to us. So stick around. We'll be right back. And
see you in a minute.
See you in a second.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
And so the topic so far that we've been discussing this week is earnings. And last week on one of the examples, one of the user picks, we discussed Morgan Stanley, and you had broken down an interesting way to approach that, a short-term options trade. And I think we want to revisit that. We want to see if there was a positive move in the trade, but also did the setup work out the way that we wanted it to?
Yeah. Just to review for everybody, what we were talking about last week was what would be a predictable way of trading an earnings play, right? A lot of folks always come to me and say, do you have a sentiment for this stock or that stock at earnings? And I have to be honest, unless you have insider information, even if you do a really good fundamentals analysis, a lot of times you never know how investors are going to respond to an earnings announcement and an earnings call, right? Good news could be bad news, like what we're seeing right now, where, bad news is good news in the broad market. You might see a tipsy-topsy, or you might see good news and investors get pretty excited about that. And so you never really know what's going to happen, even if you have a good idea what the company is going to announce. Guessing what the investors are going to do is really like a crapshoot. It's really like going in and just gambling. And so I never try to trade directionally because it's just not predictable. It's not something I want to do. It's very speculative. So then I thought, you start to think, what is the predictable play every earnings? And so we talked about this last week. What's very predictable is that ahead of earnings, investors tend to get anxious. They tend to get a little bit excited. There tends to be a little bit of confusion, uncertainty, doubt, right? All of these emotions, and they cause investors to start to want to hedge their investments. And the best way to hedge their investments is by buying options. And so what we tend to see, no matter what is expected to happen with earnings or what really happens, whether the price goes up, down, or just stays sideways after the earnings, is that ahead of earnings, we see a lot of option buying, and that almost artificially raises the price of options. And so going into earnings, we like to be the seller of these options because we're going to get top dollar on this artificial raising of the earnings. And then what we tend to see right after earnings is released is a calm, a relief, right? And investors are like, I'm glad that surprise news is behind us. Now that things are calm again, I can sell back those options. I don't need them as hedges anymore. And again, now we artificially raise the price up. Now we're going to artificially drop it back down. And that's when we want to go ahead and buy to close our position. So what's neat is, number one, options can respond to this change in investor sentiment. And number two, we like the fact that we can position ourselves on the correct side of the equation, sell when prices are high, buy to close, or buy back when prices are low. So we had a gentleman last week who brought us Morgan Stanley right ahead of earnings. So I'd love to take a look here at how that played out. So I'm going to come back here and I'm going to remind myself when earnings was released. It looks like earnings was released on July 18th before the market opened. So I almost want to go back to July 17th and look at this investor sentiment. So if I come over here and I use our historical lookup for Morgan Stanley on July 17th, what we can see here is if I look at the at-the-money option, so let's look at the $85 strike price. If I look at the $85 strike price, what you'll notice here is this number called the implied volatility is 40.32%. That's a measurement of how much kind of anticipation and anxiety is built into that price, 40.32%. Now, take a look over here on July 18th, and we'll look at that same number, and I believe that was the $75 strike price. And you'll see here that, well, we've got a jump in the underlying symbol price. Was it 75 or was it 85? It was 85. Here it is. So you'll see here, of course, the data isn't playing nice, but you'll see here that the implied volatility, okay, it's not playing nice because we have a little bit of a price hype. So that actually brings in another sentiment here. What we want to do is we want to have a calendar spread. And so what's nice about a calendar spread is that we're going to, in order to sell those options on the day before earnings and then buy them back the day after, we need to have kind of a covering position. And we usually pick an option that's far out in time, like 6 months. So I'm going to look at the January 2024, and we're going to use the $85 strike price. So let's do the same kind of balancing act here. You can see here the 85 strike price was 25.34. This is the day after earnings. We're hoping for very little change. So let's look at the day before earnings. And so you can see the day before earnings, our volatility hardly changed at all, right? It went from 24.77, and then the day after earnings, it went to 25.34. So hardly any change. And that's good, right? Because we want that one option that we buy to hardly change in price, and the one that we sell to change pretty drastically in price on this earnings. So let's throw this together. You've got this purchase price of about $10. We'll go back the day before. Okay, $6.90. So I'm going to pull up a calculator. It came up over here on one of my other screens. Let me pull it up.
So many screens.
Oh my goodness. All right, so we pay $6.90 in order to get that initial covering position. And at the same time, we come here to July 21st and we get that $85 one that we sell. So we sell this guy and he's going for $2.32. So we get $2.32 back. So to start this trade the day before earnings, we wound up spending something like $4.58 per share. Now, the day after earnings, and so we're going to see two effects here. The day after earnings, when we go to sell that thing, we'll start off here with the 85, $10.67.5, $10.67.5. And then the near-term option, if we look at the 85 strike price, went for $6.97.5 minus $6.97.5. And so we've got $3.70. Okay. It's in this case, Morgan Stanley had this huge jump in price. And so it didn't work out the way we wanted to, right? We wound up investing. What did it say? We invested something like $4.58. And then because of the huge jump in price, it looks like it dropped down $6.90. Oh, yeah, it dropped down to $3.70. Okay, so my strategy is kind of backfiring on me because of the huge jump in price. This strategy works fantastic when you have very little price. So if we look last time, we had very little price action move. And so this strategy worked really well. This time we had a big jump in price. And so what you want to do is actually wait before you get rid of this to see if price drops back down to approximately the price where you bought it. Interesting. I'm actually learning on the fly here with this one because, and I might be doing my math wrong. I should have probably done it in advance, but you know what? The idea is that we sell when implied volatility is high and we buy back when implied volatility is low. That's that front month option. The back month option becomes stable and its price doesn't change with implied volatilities at all. And that's the idea of crafting this trade.
And so if there is a pullback, you could still get out with a winning trade. But my question is, how long of a window do you have for a potential pullback? Or like how
So
long would
that
you be willing to wait?
However, so we used an option that was expiring. Well, today's option's expiration day. Generally, when I sit down and I recommend this trade to our folks, I usually say go about 10 days out to expiration. So if we take a look at the option, not the July 21, but the July 28 option, that might have been a better selection to use. So here we've got an implied volatility before earnings. Let's look at before. So if you look at this 85 strike price, it's 33.52. And then let's see what happens the day after earnings. And let's see if we get that differential. And again, we've got the 38.86. So we didn't have the differential we want really because of this big jump in price. So you have until that front month option expires. So basically, if we would have used the 28 expiration, we have the next few days to see if this starts to drop. And it's already hinting today that it does want to drop. We'd have to see how that plays out. This is an interesting example for us, Sip.
And then what if the reaction were to be in the opposite direction? Would the return be dependent on the extent of that move, or are you winning or losing if the stock moves up or if the stock moves down? Is there a difference, or we're just looking at overall movement?
So here's the interesting part about this strategy. So if you think about it, I'm buying this option that's really far out in time. I'm buying this option that expires in January of 2024 and then selling this option that expires like either this Friday or next Friday. And by buying that one option and then selling that other option, it cancels out what we call the intrinsic value of the option, the part of the option that is linked only to the direction of price. And so by canceling it out, in theory, this option does not have any sway based on the underlying symbol price. Now, in reality, the other component of an option price, the extrinsic value, also has a directional component, as well as this implied volatility and this theta decay component. And so what we think about there is that if you have an extreme price action, either up or down, it can affect this strategy. So one of the things we try to do with this strategy is we either try to wait and get in at the same or close to the same underlying symbol price, get in and out when the underlying symbol price is approximately the same. So if the day before earnings, the underlying symbol is at about $85, we'd like to get out when the underlying symbol is around $85 at more. And there's a little bit of slop, but roughly the same underlying symbol price. Or if you do have some sort of fundamentals like understanding of what the earnings might do, you could actually add a small directional component. So for instance, if I would have, on the day that I was buying that calendar spread, bought it knowing that there might be a move up, again, you don't have to be perfect, but if I would have done the 90 instead of the 85, that would have created a double whammy and really made a profitable trade. So there's a couple of different ways you can do this. Definitely look at the fundamentals of the underlying symbol before earnings, and look at past earnings and see how do investors tend to respond to earnings plays on Morgan Stanley. One of the ones that my program participants and I also played was Delta Airlines. And on the Delta Airlines trade, you can see here there was very little price action after earnings, and within 3 days, it came right back to the price that we had right before earnings. And there was gains that I saw from my program participants anywhere from 8% up to 15% for just having the position for 3 days or less.
Awesome. And so that, once again, is called a calendar spread. Yeah.
Yeah, it's a calendar spread. That's where we have the two legs of the spread have the same strike price, different expiration dates. The back month option, we want about 6 months out in time, whereas the front month option, we want probably in the next 10 days. We often use weekly options for that front month option.
Awesome. All right. So that's a great strategy to be looking at during this earnings season in the middle of the summer doldrums. If you're looking to be active, definitely a good example to try and implement into your portfolio, into your paper trading account. I know that it's a concept we've discussed a few times on the show. And moving on to the rest of the show, I know you guys are sitting very curious, wanting to know what AJ's got on the docket this week, what he's looking at. And so we'll go ahead and head into AJ's pick of the week. This is, I believe, an interesting industry that we don't really cover much. And your pick of the week this week is United States Natural Gas, ticker symbol UNG. And so what's the play there? What are you looking at? What's the time frame? UNG.
Yeah, UNG, this is an ETF. This is an ETF that has a basket of symbols under it that represent the kind of the price action of natural gas. And natural gas, as you can see here on this chart for UNG, somewhat boring, sideways, has a little bit of chop to it. And guess what? That's what us premium sellers really like, is this sideways chop. So I was looking at this and I was looking at the predictability of it. 7.5% or $7.50 is kind of our high. Our low lately has been somewhere between 6 and 6.5. And if you look at the options chain on UNG, you'll see that these options are traded about every dollar. And so I was looking at the strike prices of $8 and $6 and, realizing that this would be a really fantastic trade to do with those two strike prices. And I see that I'm about to be forming a top up here. So what I wanted to alert our followers to was perhaps a trade when we get a signal that a top has been found, when the underlying symbol is somewhere probably between $7.50 and $8. The key point here is that not only is it at that price range, but that it starts to head down. I might really consider either shorting this ETF or buying a put option that's probably out. Let's see where the expirations fall on these put options. So if I take a look at, I like this March 2024 option. That's a great expiration date. So I would probably buy some March 2024 put options. And so I could see myself using maybe this $12 put option, going pretty far out in time, pretty deep in the money. So instead of having to short for about $7.25, I would instead go long for about $5.15. And that would set me up to be able to sell put premium and roll out protective calls for the foreseeable future. I mean, look, we've been doing that since March, and it looks like natural gas is probably going to be going sideways until the winter season when people start using natural gas again to heat their homes. And so I've got about 3 or 4 months that I could probably collect more premiums on selling natural gas. So now is the good time for me to short or buy that back month put option.
And I'm assuming at $7.50, something like that. It's a really healthy price to be putting on some of these positions. And
affordable.
We've done the comparisons of $7.50 stock versus a $50 stock versus $100 stock. So if you have a portfolio on the smaller side, this might be an opportunity to try and practice one of these premium selling trades. And if you are looking for an ETF to get into, this is something that's more commodities based if you're looking for some diversification. So UNG has been added to the list. We're going to be keeping an eye on it. Probably not too much movement, but boring is good. Like you said, there's more consistency, more winners over time without losing sleep at night, essentially. All right. So AJ's pick of the week, UNG. Moving on to our speed round. All right. Throughout the week, we've got users from all across the country, all across the world, throwing out some tickers. And this week, we've picked out a few to go over. Some might be opportunities, some might not, but we're going to be discussing them all fairly and giving them a chance. So we're going to head on over to the west side of the country. And this is Carter in Reno, Nevada, interested in a new name, Coeur Mining, ticker symbol CDE. AJ, do we have an opportunity here?
Yeah, and what's interesting, so this is the Spanish word for heart mining, right? So this is a company that focuses on mines here in the Americas, so both South America and North America. They actually have a Nevada mine. They have some mines in Mexico, and then they definitely have some mines in Bolivia. And they focus on precious metals like silver and gold. And so let's take a look at what we've got going on here. So first of all, playing on the same theme that we had with natural gas, this is an inexpensive stock. And so for folks with smaller portfolios, this might be something to take a look at. If I take a look at the option chain, that's the first thing that I want to think about is, do I have options? So yeah, it looks like I've got pretty active options chain here. At the bid-ask spreads, I'm looking at the open interest. So I've got enough liquidity to make it worth my while. In fact, even more liquidity in the leap. So I might consider using it as a protective option. And if I look over here, I mean, it looks like I'm testing a level of support at $2.80, maybe as low as $2.60. And I'm testing a level of resistance probably up here around $3.50. So I am excited because I think that I can get along well with the $2 option and the $4 option. That would create a nice delta between those two that I could probably pull some nice income out of here. So the first thing I need to do in order to sell premium is I need to set up an initial covering position. So whenever you want to sell options, you have to have some way to cover that option that you're selling getting exercised. So since we're at a top in this channel, the way to cover any sort of premium trade would be to either short the symbol like we were going to do with UNG. You could either short this stock or you could buy a back month put option. Either one of those two trades will cover future premium sales. And since we're selling a put or buying a put option or selling the stock, then the premium trade that we would do that matches up with that would be selling put options and rolling out and buying protective calls, buying those protective calls and then rolling them out. And we would do that every time we bottomed. So I think that's what I would probably do here. Let's see. I don't see that there's an earnings scheduled. The last earnings, if I bring us back to this chart, the last earnings was reported May 11th. So June, July, August 11th. So we do have a good 20 or 21 days out from when we're going to see that earnings release. And it doesn't look like investors tend to flinch too much during earnings. So I don't mind being in a premium trade as we get, 20 days from earnings. So yeah, I think that's what I would do. I would make sure that this is a top that I'm finding here. I would either short or buy a put option. And then every time I bottom, I would sell premium, buy my protective calls, let that premium expire, roll out the protective call at tops, rinse and repeat, start that income generating process as soon as possible.
I have an assumption that Carter knows a little bit about the company coming out of Reno, Nevada, but
Maybe.
that's a play if you're interested in holding the name over the long term, collecting some of that premium, and watching your investment grow. So thank you, Carter. That was CDE. Moving on to our next ticker, we're gonna head on over to the East Coast. This is Judy from Trenton, New Jersey, interested in the fashion brand Victoria's Secret, ticker symbol VSCO. It's swimsuit season, AJ. Victoria's Secret's got to be crushing it.
Yeah. My experience with Victoria's Secret is they recently, like 2020, I believe, rolled out from L Brands. So L Brands was their parent company. The L Brands owned stuff like Bath and Body Works, Limited. In fact, that's what it was. It was originally the store Limited, and it was Limited Brands, and then it got shorted to L Brands, and it had all these other names like Victoria's Secret under it. And then, about 2 or 3 years ago, Victoria's Secret was rolled out on its own. So let's take a look here. It seems to have bottomed. Now, I usually like to see the bottom get tested some, but let's zoom in a little bit. Let's see if we can't focus our eyes on this tail that has formed here. So it looks like we're looking at some sort of level around $17 and another level maybe around $20. So you've got this $3 movement, and it doesn't look like it's too aggressive. So this could also possibly be a premium trade. And I think we're double testing a top here if our technicals make sense. The last time we had earnings was on June 1st. So we're not expecting earnings again until September 1st. Yeah, okay. Let's verify now that Victoria's Secret is operating on its own that we've got options. Okay, so we're trading every $2.50. There are some options to be had. The bid-ask spread is a little bit large. What that's telling me is there's not as much liquidity as I would like. And let's see, if we have $20, $22.50, $25, $20, and then we have our $17.50. I think that we could probably encompass this price action with the $17.50 and either the $20 or the $22.50. So I think that it's possible there might be easier trades out there for you. But I don't think that this is a lost cause. I would wait to verify that this double top is indeed a top. And then just like we've been saying with our other symbols, I'd short the symbol or I'd buy some back month put options. And then every time this bottoms out, I'd sell a put option for a premium trade, buy a protective call. And then when it tops out, I'd roll out that protective call and I'd let that put option that I sold expire worthless. My protective options always 3 to 6 months out. My sold premium options always near term, and I'd rinse and repeat, rinse and repeat. Looks like there's something to be had with Victoria's Secret. I'd paper trade it, and I'd paper trade it at the same time I was paper trading some other symbols and see which one actually produces the most profitable and the easier trade to do. And that would be the one I transition into real money on. But I think you could start experimenting with Victoria's Secret.
Yep, and that's not the best setup, but as you kind of indicate, AJ, there's always some opportunities to get in. And so, Judy, thank you for bringing that one to our attention. That was Victoria's Secrets. All right, moving on to another name that we've discussed very frequently on the show. And this is Roberto from San Diego, California, interested in Xerox, ticker symbol XRX, the most exciting tech company in the world. I'm joking.
At one
I'm
point.
joking.
Yeah. Yeah, sarcasm. Yeah, okay. Hey, they may not be exciting, but they sure do make money. And they also give money back to their investors. It looks like they've got earnings scheduled for July 25. So for a premium trade, Roberto, I think that we want to wait until after earnings is released. But I'm looking at the previous earnings. We did have a little move up, and then within 5 trading days, we were right back down. Let's look over here. We, again, had some price action, and then within the day, it was right back down. So I think I might even consider an earnings play here as I'm waiting for the premium trade to set up to get past earnings. So you've got a couple of options here. I would do that horizontal spread again. Let's see what we've got for strike prices. Oh, we're trading every dollar. Let's see if we go out to January. Yeah, every dollar. So I might consider either the 15 or the 16. Maybe the 15. And here's the scoop. Pay attention to what the underlying symbol is doing when you buy that calendar spread with the 15 strike price. I would, again, go out a few days. So if earnings is scheduled for July 25, let's look at our weekly options really quick. Oh, okay. I'm not seeing, let me make sure I'm looking at weeklies. I'm not seeing that Xerox actually has weeklies. So let's use the August 18 option as our front month option. Let's use the January 2024 as our back month option. We'll use our $15 strike price. We'll place that trade ahead of earnings. In fact, it might even make sense. This is going to be the 25th. So if it's the 21st, 22nd, 23rd, 24th, I could see, and is this before market open? Yeah. Monday. So on Monday, I could see buying that calendar spread. Pay attention to the underlying symbol price when your trade actually goes through. And then after earnings is released, wait for the underlying symbol price to be roughly at the same place. Sell that calendar spread, take advantage of that difference. We might come revisit this trade next week to see how it played out. And then, come Tuesday, start thinking about your premium trade. In this case, we're at a top. So just like all the other examples today, we either short the symbol, buy the back month put, and then we wait patiently for a bottom to be found. When the bottom is found, That's when we throw some protection on with some protective calls, out of the money protective calls, probably with the 16 strike price, 3 to 6 months out. And we sell premium. So we sell near term at the money put options. Let those things expire worthless. Let the call option roll out income. So I mentioned 2 trades here. I do them both. I do the earnings play Monday, get out of it Tuesday, Wednesday, Thursday. And then on Tuesday, Wednesday, Thursday, start to look for that initial covering position to then sell premium for at least the next 3 months.
All right, Roberto, you've got some options there, some options to trade, some options, some
options with options,
some decent setups there. And so that was ticker symbol XRX, company Xerox, and that concludes our speed round. But what I did want,
should we do the one that was there was one thrown into the comments? Should we do Citigroup really quick?
Let's do Citigroup. It is a lot of banking the last week, right? Last week and a half.
Yeah.
So Citigroup.
Now this is one I would love to have examined for an earnings play. You can see here the day before and then the day of and the couple days after. This would have been one where the implied volatility would have played to our benefit, just like it was a textbook trade. But now that that's gone, you've got Citigroup. I see a little bit of consolidation, which gets me a little bit worried. So when underlying symbols consolidate, what that means is the investors are a little bit confused or uncertain about where prices should go next. And that kind of leads up the story towards a potential breakout. And that breakouts are not usually premium sellers' friends. They're not premium sellers' enemies, but there's different option strategies that are better for breakouts than a premium selling trade. So I almost am cautious about setting up a premium trade on Citigroup right now until that uncertainty plays out and we've got a little bit more confidence on where Citigroup is going to go next. I almost feel like we've got a dividend that's going to be released on August 4th. I almost feel like let's get past the summer doldrums and look for an opportunity for Citigroup. That's my knee-jerk reaction, is that come Labor Day, Citigroup might get something might spark the investors to either start accumulating or distributing, and we would have a better idea of, is this a premium trade or is this something where we want to trade directionally? Now, if you do want to get into a directional trade during the last month of the doldrums here, the August, make sure that as soon as you get that differential between your initial covering position and when you want to place on that premium selling, that you get that premium selling and protective option in place. Because if you've got your premium selling and protective option in place and a breakout occurs, the whole strategy self-adjusts and deals with the breakout just fine. And where we get into problems is if you don't have that strategy in place yet, where you're waiting for the timing and then you have the breakout versus having those positions in place and having the breakout. When you have those positions in place, when you have your premium sold and when you have your protective option, you create a self-adjusting strategy that can deal with anything that's thrown its way. So just strive to get that in place if you're going to start trading it earlier rather than later.
And I have a quick follow-up to this. If the consensus for rate increases is 100% next week, how is that going to affect the banking sector and the banking stocks? Is that going to be positive or negative news?
I think it's going to be nothing news. If things go as expected, the banks are going to just be able to absorb that. Investors already expect it to be happening. I don't think you're going to see any difference.
Okay. All right. That's Citi. And want to remind everybody that's watching real quick that if you've enjoyed the broadcast, you've enjoyed some of the analysis that AJ has provided, He does offer an exclusive one-on-one trading program. And so if you're looking for a little bit more hand-holding, a little bit more coaching, there are a few seats available. And so we're going to go ahead and throw the link to that into the chat. But sometimes, if you're new to investing or if you have a portfolio that's a little bit more complex, working with someone on a day-to-day, week-to-week basis might be exactly what you need to get you heading in the right direction to really take advantage of the portfolio. So the link to that is in the chat. That concludes our speed round. We're in the middle of the summer doldrums. Today is options expiration day. AJ, payday for the premium sellers. That's right. And next week we've got the rate, right? Next week we've got rate hike or not details. So what are we doing today? Are we going to be letting our trades expire today, head into the weekend, relax, come back Monday with a fresh mindset? What are you looking at? How are you positioning yourself?
In general, once our sold premiums expire, so we have a whole bunch of July 21 options that will expire today. Once they've sold, we no longer really need our protective options in place. The protective options protect ourselves with the sold premium. So once they're expired and they no longer exist, the protective options, we can start looking for the opportunities to sell those protective options back. And we usually try to create a delta on the underlying symbol. So what that means is that we can sell those protective options back either at break even or more likely at a little bit of a profit. So even though we held them and they protected our trade while we had premium sold, they now become a vehicle for us to get a little bit more profits onto our overall position. So next week, I'm going to be looking for opportunities to roll out my protective options, sell them, kind of reload my cannon to buy them again the minute I sell premium the next time. So I'll be looking for opportunities to sell back my protective options, as well as setting up these initial covering positions. So we looked at 4 today, 5, including the one that came live on Citigroup. We're looking at 5 different candidates, and a lot of these we're looking at setting up that initial covering position. So a combination of rolling out protective options on our existing positions and looking to set up the initial covering positions. Basically, these are all tactics to reload ourselves so that we're ready to sell premium in the next week or two.
And if you're interested in being part of AJ's weekly mastermind call or learning more about the program, head on over to tradingtrainer.com. You should be able to create a free account there. You'll be provided with some information on the next steps. So I highly encourage anyone that's interested to head on over there to check it out. In addition, if you've enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. We are doing our best to provide you with quality content every week, opportunities to help you become a better investor. All right, AJ, appreciate your time. Appreciate everybody tuning in today. I believe that's going to do it for the show. Any big plans for the weekend? You get to go check out Barbie, Oppenheimer, any one of those?
Oppenheimer is more my speed than Barbie. But I do have the little one who, it would be awesome to have her get excited about something in the theater. So who knows? I'll leave that up to my wife to select.
Yeah, I'm more of an Oppenheimer guy as well, but
I wanted to see Oppenheimer in IMAX for sure.
Oh, okay. Yeah. I'm seeing rave reviews. So definitely love a history World War II type of flick. That's right up my alley. So how about if you want to know what we think, hit us with the follow and we'll leave some reviews on the social. With Perfect. That, AJ, appreciate your time. Appreciate everybody tuning in. We'll catch you guys next week.
Bye, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.